Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So I know some of you did miss us last week. You know, we didn't have our EIA and our Econ show, but now we're back and we'll have the normal EIA today, Econ tomorrow, and then obviously the FSC show coming on Friday. So one of the things that we want to look at when we're talking about the EIA data is how the shifts continue, because we saw the big number from US exports and we want to go through some of these key pieces. So we're going to break it into our normal 3 sections, and we want to look at how the crude flows continue to shift as Russian oil is just going very aggressively into Asia. We want to look at, but how is that shifting the market? How is that moving things around? And then when we look at the demand side, now for anybody who knows us, we would have said that 8.5 million barrels a day of gasoline demand last week was low. So we would have expected to see a bounce. But again, if you remember, we said about that 9.1 to 9.3 million, but really averaging close to 9.1 million on average on the gasoline side. So we do expect to see demand remaining soft, but we're going to go through that on the refined product side going into August. And then in the last segment, we want to talk obviously on the global market, but we really want to hone in on that diesel versus gasoline. Because if you remember when we started talking about all of this way back at the beginning of the year, we were discussing the differences between diesel and gasoline, and that is going to continue to be a driver. Both crack spreads have come down, but gasoline has obviously come down much more because we do have a growing gasoline glut on a global level, while distillate continues to be in a very bullish spot. But we want to go through that in more detail. So now when we turn to what has happened so far, when you look at the total oil product stocks, you can see that the deficit now are from 75.1 to 68.7. And if you remember, one of the things is we were saying is we were going to come back within the cloud of that, the last 3 years, but we're really going to go sideways, and we don't see a huge, a big move back up. But one of the things is that just means the comps get easier as we progress throughout the year, because we normally have that drop in total oil and product stocks. But in terms of where we're sitting, obviously distillate continues to be, or I should say middle distillate continues to be in a bullish spot. But gasoline builds remain everywhere, gasoline light distillate, depending on where you are. And when you look at Singapore, the US, and Europe, but more specifically Europe and Singapore, we continue to have these massive outsized builds. So then the crude stocks, as we've been saying, is just very steady. We don't see a huge surge up, a huge surge down. Crude, we think, is going to stay fairly stable, which you've seen here, but the comps get easier, which is what we've been saying. And that's where we're coming closer to a quote unquote normal backdrop when you look at the total crude, land, and floating. And then on the oil product stockpiles, we continue to move up along seasonal lines, but still outside of that, what could be the lower end of that cloud. And again, a lot of that is driven by the Middle East. Now, as I was asked to write an article by Steven on Libya, and I think it's important. I'll give a quote for his article on Libya, because I think it's very important to understand how the different structures are. So Libya has now boosted oil production to more than 1 million barrels a day, which, if you remember, prior to the force majeure, they were at about 1.2, 1.3, and they were exporting closer to about 1.1. So they're getting back to that little piece, with the oil minister saying that they're back to a little over 1 million. Now, it's important to appreciate that there has been some loose alliance that has happened. Their politics continue to be very fluid, or remain fluid in the region. So again, we don't see this impacting crude right away. It's they both sides recognize the importance of needing this revenue. And so when you think about the shift on the reopening of fields and the export terminals, they were at about 560,000 barrels a day. Now they're at about 1 million. So getting to about that 1.2 isn't really a huge stretch. But one of the things that we've been talking about, and it's going to be within this whole structure, China's appetite for Russian oil continues to reverberate through the system. So Russian ESPO, one of the key pieces, and we'll talk about this again in segment 3, continues to move east at a discount of $10 to $12 a barrel, but it's competing against other things, not just obviously Brent but also Brazil and some other pieces. So Brazilian crude is trading at about $1 or $2 above dated Brent. But when you look at where the ESPO is, it's trading $10 to $12 below dated Brent. So you're continuing to see this adoption and this flow through from Russia into both China. But now China is even getting competition on ESPO barrels from India, with 4 of those cargoes actually flowing into India, which is not a very common move because China usually absorbs a significant amount of it. But now we're seeing more of that actually going across and into other areas. So China and India have been willing buyers of Russian crude after most of Europe and US have halted direct imports. Again, we don't see that changing. ESPO is being offered at a discount of about $1 to $2 below London Brent oil prices, but that's really $10 to $12 below Lula and other Brazilian crudes. So traders have said that Russian grades such as ESPO are among the cheapest available on the spot market after taking into account its quality and yield. Cargoes can be shipped to China in around 5 days compared with about 2 months for oil from Brazil. And again, you're going from Brazil, you have to sail to China versus you're coming out on the eastern side of Russia and then you just drop straight down and you can hit pretty much the furthest port in China within 5 days. So again, there's also that speed to market. Now, China's independent refiners or teapots or Shandong refiners, as we talked about, and also state-owned processors have purchased most of the cargoes of ESPO that are shipped from Kozmino port in the past week. Cheaper Russian crude is allowing companies to cash in on improving refining margins. But at the same time, this is also allowing the teapots or the Shandong refiners, which we'll talk more about in segment 3, to operate at very elevated levels, even as state and really the large mega refiners continue to be, or I should say struggle really, because you haven't seen China really come back in a meaningful way. So now when we look at land storage, here you can see that the deficit narrowed from minus 54.8 to minus 48. Again, it's not that we're going to get this huge shift up. It's a gradual move up, but the comps get easier. And that's just what we've been saying. Land storage west of Suez continues to climb from 39.7 to 30.9. Again, it's sideways. But you can look at the pink line, which was 2021, how it comes down, how the average of the 3 years comes down. And again, the comps are just improving and getting easier, while east of Suez continues to be fairly stable. But we do see that, again, also growing as well. Now on the floating storage side, the surplus narrowed from 19.9 to 11.9. We are getting a bit more flow through, but there's also that timing delay. So there's a little bit less in floating storage, but a lot more in transit. And that's something that we're going to touch on in the very first part of segment 3, because it's important to look at, as we've been saying, those timing shifts in terms of what has been exported. Is it in transit? Is it sitting in floating storage? And you can see that even as miles per ton continues to grow, as you continuing to see these shifts, we still have a significant amount of crude that's sitting in storage. But it's something that we just think, again, continues to go sideways. West of Suez, fairly normal when you factor in Europe and the Gulf Coast, but West Africa continuing to climb back up because a lot of that purchasing has slowed down again, as we're seeing more and more of that Russian crude, because if you're not buying it from Brazil, they're not buying it from Africa. And now you're starting to see some of that Angola and Nigerian crude increasing into Europe, as we are seeing with the Middle East as well. East of Suez continues to be fairly flat. We think that is going to continue to be fairly stable and really not have much of a move up or down. So then when we start looking at Chinese oil demand, you're seeing some of that peak congestion normalize. We expect it to continue to come down a bit. Macau has shut back down, or at least some of the facilities have shut back down. We're seeing some of those slowdowns in general when you look at activity, just because of some new COVID cases. Zero COVID policy continues to be the focus. Road cargoes remain low when you look at it against the 2019 average. Same with flights. So when you, on average, they're still lower. Gasoline is still doing better, but then when you start factoring it in, as we've been talking about, on the industrial side, on the real estate side, on the just economically speaking, China continues to struggle, and we don't see that changing anytime soon. Then when we look at some of the gains into China specifically, we have 51 cargoes of crude are due to load for Asia in July coming from West Africa, which equates to about 1.57. Shipments to India are set to drop slightly, drop to 184,000 barrels a day, which is the lowest since June of 2020. And that's why you're seeing those shifts. Now, while those shifts are happening, almost a third of Angola's crude are heading to Europe and North America as sales to China stay below their typical rate. Again, China is struggling on its own right. Plus, you have the amount that's coming from Russia that is, again, new flow. And then obviously less is going from the West Africa into India for the same reasons. All the while, you're seeing some gasoline exports and exports in general remaining elevated from India. Nothing crazy. It's not like it's this huge surge, but you're just getting an idea that they're still remaining above that 5-year average, just as India is trying to capture the better margin. And and that's why if you remember, I know it was a long time ago, but 2 weeks ago, we talked about how India was actually going to lessen some of those increase in export tariffs, just because even with the export tariffs, it still made sense to get this product into the international market. So bring that down, try to balance it a bit, not force, but have some of these export facilities preserve some of it internally. And in exchange, they would lower the tariff and, again, increase the amount of flow. And this just looks at India diesel continuing to remain elevated. And it's just because, obviously, even as the margins have come down, they're still in a very positive light. Now, when you look at the Sumid shipments, and this is crude that flows through the pipeline, have soared since Russia's invasion, and this is the pipeline that connects from the. So instead of going through the canal, instead of going through the Suez Canal, you just essentially go around and you can pump it through. So Saudi Arabia and Iraq are diverting more and more of their crude oil toward Europe. Not surprising, given the fact that a lot of the refining or needs, if you will, have been taken in Asia. So that just frees up more of it to go into the other markets, with, as you can see, Northern Europe and the Mediterranean taking a significant amount. And this is even more so than when Russia invaded Ukraine. And we expect this to remain elevated. Now, obviously, there is a very specific timeline. And just to give you an idea, again, it goes through Europe, it goes through Egypt. So when you look at it, more than 1 million barrels a day of crude has made its way to Europe from the Middle East in the first 3 weeks of July via the pipeline that crosses Egypt. Russia's invasion of Ukraine triggered a backlash, which obviously has shifted those flows, and we don't see that adjusting. And as you look at some of the different meaningful moves, so obviously Libya coming back will help, but it's not going to stop what's coming through the Sumi pipeline, because it's still important. There's still shortages that have to be addressed. 2/3 of CPC crude exports typically end up in Europe, and we expect that to remain the case, but there's that unknown of what is the Russian judge going to do. They've been playing that card back and forth, especially as Kazakhstan tries to distance itself a bit more from Russia, and again, creating some of these issues. And then when you start looking at curbed gas supply, so it's important, and we'll talk about this again on the FSC show, but Russian gas flows to Europe have fallen to multi-year lows. You're already starting to see the talk of industrial run cuts in terms of natural gas demand, just because there is a shortfall there, and they're going to preserve to make sure there's enough for heating needs of the home. But again, you're also going to say, okay, well, if I can't get natural gas, can I get coal? Can I get diesel? And that's where you're going to start to see a bit more of that demand. But diesel prices are elevated. Thermal coal prices are elevated. And just given what this chart looks like, as you can see here with Nord Stream, Ukraine Transit, all the different movements, there's a lot of pressure that's going to be in the system. But even as all of this is happening and we keep talking about gasoline and diesel, I wanted to introduce this because the U.S. Gulf Coast gasoline has never been weaker versus futures. because when you're looking at the dynamics, there's a lot of gasoline in the market today. There's a lot, and again, we'll talk about where the gasoline sits, because when we'll go through this further, but PADD 3 is 3.8 million above the 5-year average. Like when you look at the underlying gasoline storage situation, it remains PADD 1, not PADD 3 with the issue. So wholesale gasoline in the U.S. Gulf Coast is trading for 51 cents a gallon less than the benchmark New York futures, the deepest discount in a decade of record keeping, just where we've been looking at it. Sellers lowered offers on the last day of trading against the August contract before the pricing basis rolls to a much weaker September, because obviously as you're coming out of driving season, but it just goes to show there really isn't a whole lot of driving demand, again, versus what is normally expected. And we still hold to the fact that July 4th is going to be the high for the summer. And we have charts that just show and reflect that. The drop in physical markets is also a reflection of the unseasonal slowdown in demand at the height of summer, brought on by historically high costs and, again, lower demand because of it. So now when we look at the capital cutback, you're also seeing, on the other side, on the supply side, you're just not seeing the same type of the snapback. In 2013, when crude prices are 100, you can see that investments are nearly half. Now there's a lot of advancements in terms of price, in terms of cost. Offshore drilling, back then when you look at 13 and 14, I mean, let's just, for anybody that's been in the industry long enough, what offshore day rates look like. So you can still get a certain amount of exploration, but it's just showing that the money is being preserved. You're not seeing money getting thrown around as before. There is talk of those surge taxes, which is going to force them to keep money on the sidelines. And those are going to be important things to look at as we go forward. So now when we start looking at the U.S., here you can see that there was a draw of 4.5 million barrels. That brings us 59.7 below the 5-year. With obviously, when you look at the backdrop, it remains PADD 2 with the biggest drawdown. PADD 2 drew another 1 million barrels. It's 25.4 million below the 5-year, with Cushing, small build, but still 19.8 million below the 5-year. And as what we've been saying, Cushing we expect to be fairly flat. PADD 3 had a small draw, but when you look at the backdrop, PADD 2 and 3 had a drop in imports. We do expect that to recover, which will bring PADD 2 back up, but PADD 3 is going to be fairly flat, as we've been saying. And then once you factor in the SPR, there was a draw of 10.13 million as more continues to get pushed into the international market. But that will start to reverse in 2023 when because you have to remember, some of the SPR, again, not all of it, was lent out, not sold directly. So that means that it has to come back with interest. And that is going to revert. That's going to start in 2023 at this point. And then when you look at production, we're back up 200,000 barrels to 12.1 million barrels a day. Again, we never really saw a huge drop. Remember, there was that one drop that we discussed on the FSC show. But one of the things is this a big pivot? Is this more of a moving day? And this data also kind of gives us confidence that it was more of a moving day and less of a bigger pivot. But it does show that there is that limitation as we go forward, and that's something that we discussed on our article with AOGR. So then when you look at runs dropped by 1.5% from 93.7 to 92.2%. When you look at who drove it, it was PADD 2, which fell 216,000 barrels a day. So again, that is something that is below the 5-year average. We do expect some of that to come back, but there are some downtime. There are some turnarounds planned. So again, we're not going to see a huge shift. And even with this adjustment, European gasoline exports to the U.S. remain fairly soft. They're down more than a third than the previous month. But that's something that we do expect to come back a bit, just given the disconnect between PADD 1 and Europe. So then when you look at utilization rates, you can see that there's been dips here before, so it's nothing crazy. But it's when you look at the underlying volume per day, it's not the same. And that's the problem that we're having right now in terms of some of that flow. But we have to look at crack spreads, and crack spreads have come back from significantly high levels, and you're going to see that remaining and keeping pressure on what that utilization rates look like. And it's just a matter of how long can the diesel crack support the gasoline crack? Because as we've been saying, gasoline is a huge problem. But right now, the diesel crack is carrying it. But as that weakens, as that softens, then you're going to start to see the overhang. You're going to start to see some of that underlying pressure. So imports dropped 356,000 barrels a day. That's over 1 million barrels a day below the 5-year average. And most of that continues to be by PADDI, which dropped by 41,000 barrels a day, which is 709,000 below the 5-year. That's something that we were expecting coming in a bit closer to 1.6, 1.7, but so far we've been hanging out between 1.5 and 1.6. And even with the additional purchases coming from the international market, we're just not seeing a lot of activity in that region. PADDI imports, you can see it's still higher on the higher end for 2022, but it's still very low for this time of year as we're bumping along the bottom. We thought we would be, let's call it, the 150,000 barrels of a day above where we are right now. But you're just not seeing a huge reaction from the refiners and from the activity in general. So we don't see it going much lower from here, as we've been saying, kind of bumping along the bottom. But we do think that there will be some of that time lag, because we did get a big swath of purchases from the Middle East, but more importantly from West Africa, and that will show up, and that will take us a bit higher. But but at this point, it will be fairly short-lived. PADDI imports remain elevated. That's going to stay the case. It's going to be above the 5-year, but below, again, the top of the cloud as we continue to pull in more from Canada. And PADDI refiners remain fairly active after even this dip. So implied demand increased 724,000 barrels a day from 8.52 to 9.2. That's still well off the 5-year average, well off the average in general. And again, we don't see it getting much better. And this is that peak period, because from July 4th till essentially the second week of August is your peak vacation time, and we just see that slowing down a bit. Remember, you have the South that normally goes back around August 16th, same with the West Coast, and that's where you're starting to get towards the later end of that peak season. Obviously, the West Coast, the East Coast, the Midwest still has vacation. There's still going to be travel. It's just we're getting past the point of that peak period. Distillate continues to underwhelm, only up 53,000 barrels a day. Back to 3.75. When you look at the trucking data, the shipping data, it continues to remain soft without even really a break, with it continuing to move lower, which is going to keep a headwind there. Jet fuel, a bit better, coming in at 1.77. We expect that to come back closer to 1.6. And then again, trend closer to what we've been saying, with propane remaining fairly stable at even with a drop of 506,000 barrels a day. And then other oils swinging around as always. We don't talk about it all that much just because there's a lot to uncover here, but that's something that is going to continue to be fairly lumpy, especially when you look at VGO and some of the other pieces that come into this and into the backdrop of, are you going to make disti, or are you going to make jet fuel or kerosene? Again, those are some of the different pieces that the other oils will fall under. Gasoline implied demand, as you can see, it had that spike after that, those two lows. Last week was lower than what it should have been. It should have been a little bit higher. So I think this is a bit of a makeup number. And that's why we do expect a bit of a pullback, not a huge pullback. We're talking 50,000 to 100,000 barrels a day. So it's just going to stay fairly firm in this level, even as gasoline prices pare back a bit. Crude oil inventories, again, sideways. We don't see this changing at this point. The comps get a bit easier as we get into September, but we don't see much movement up or down on a grand scheme of things. Same with days of supply, not much change there. And then when you look at U.S. commercial oil storage end products, a small creep higher, but again, we're back to where we were in 2017, 2018, that blue line. And we just don't see much movement up or down at this point. Gasoline storage in no man's land, but as we were saying, we expect counter seasonal builds on average. And that's what we're going to continue to see. You can see, normally we're seeing that acceleration to the downside at this point in time because we are still in that peak vacation season, but we're just not getting it. And we expect to see counter seasonal builds, or at least, as we've been saying, something that is a bit greater than what is normal. Whether that's small builds of 100,000, 200,000, but we're normally getting draws of about 4 to 5 million at this point in time at a fairly healthy clip, and we just don't see that happening this year. Distillate just counter seasonal draw. It's we're not in a good position heading into heating season, and that's when we want to look at what is the driver of that, because when you look at PADDI 3 is 5.8 million below the 5-year, not too crazy. PADDI 2 is about 6.5 million below the 5-year. That when you think about where that is normally, that is actually on the low end, but PADDI 1 or the East Coast is setting new records in terms of the low side of it, which is going to be a big problem as we head into the heating season. Jet fuel, fairly firm, not much to say one way or the other. The curve, as we were saying before, or the 2 weeks ago, the front months we don't have much confidence in. The front month is going to be very volatile. We didn't understand the move in the belly of the curve, and you can see that has corrected significantly. We expect it to remain more elevated, especially when you start factoring in where is investment going. You're not really getting a whole lot, and that's been the better trade, in our opinion, when you're looking at the belly of the curve, which again has shifted back above where we think it should be in comparison to where the previous curves were pricing. PADDI 3 volume is at where we were in 2020. Again, not much to say one way or the other. If you take away that yellow line or the 2020 number, you can see that it's very normal for PADDI 3 right now. And if you were to take away the 2020 surge, we're actually right at the 5-year average, slightly above actually. So there's not too much to say one way or the other. While Cushing remains fairly flat, and we don't see that moving in any one direction with any real confidence, but staying fairly firm here. All the while, floating storage sets new lows, and some of it will creep up a bit. But again, you're seeing some of that pressure here. So that's what we have for you on that broad summary. And now we're going to go deeper into U.S. demand. And then again, in segment 3, deeper into that global market.